From the morning reading, once again, we're dealing with a lack of participation. The S&P 500 gained more than 2% on Friday, but fewer than two-thirds of stocks in volume in the New York Stock Exchange were in advancing issues. This was the ninth worst breadth day since 1940 on a day the S&P gained 2% or more. The past 2 years have been more of these kinds of divergences than any time period outside the late 90s. Despite the big up day, the new 52-week high, 52-week low ratio actually declined to 18% from 19%. This is exceptionally odd. There have only been 7 similar days since 1940 when the S&P was above its 200-day average and rose more than 2%, but the new high, new low ratio was below 25% and declined for the day. With one exception, these led to poor returns in stocks going forward. Friday jump keeps stocks in uptrend. Price pattern looks positive. Gold stocks jump on weak dollar. Prospects for higher rates boost banks. Falling oil helps airlines rise. NASDAQ 100 nears new record. Apple may be turning up. The short-term pattern looks positive. A strong rally on Friday more than erased losses from Thursday and left the market in a much better shape. The chart shows the S&P 500 ended the week back above its 200-day average after bouncing off its 50-day line on Thursday. Chart watchers will now recognize the pattern of the last month as a pennant or a symmetrical triangle, which is defined by two converging trend lines. That's usually a continuation pattern and increases the odds for an upside breakout. That would fit with the seasonal tendency for stocks to end the year on a high note. The 14-day RSI line ended above its 50-day line. Daily MACD lines look poised to turn positive. The main reason being given for Friday's surge was the strong jobs report and increased expectation for higher rates. That, combined with a big jump in bond yields on Thursday, may explain why financials ended the week on such a strong note. The plunge in the dollar on Thursday may also account for the big jump in gold and gold stocks. A drop in crude oil below $40 pushed energy shares lower. Airlines, however, got a boost from falling fuel costs. Technology was the week's strongest sector, led higher by semiconductors. Apple helped lead a Friday rally in that sector. Okay. Well, that should be enough for the morning reading today. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:01 a.m. Central Time, and I am recording this in preparation for the market day of December the 7th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into our morning report. And indeed, even with the big up move on Friday, the Sunday night into this morning is generally positive. Not enormously so, but all four of the broad market indices on the U.S. Side are up. S&P futures are up about 1/4%. Russell is just above scratch. NASDAQ about 1/4%, and the Dow nearing the same. Crude oil, though, down big, down about 2%. Euro down about 0.6%. Bonds just up above scratch, and gold just down about 1/4%. A little bit of mixed action overseas, but mostly positive. China up about 1/3%. Hong Kong down marginally. Japan up about 1%. Germany up about 2%. That's very large. And United Kingdom up about 0.5%. In terms of macroeconomic reports to start out this week for the U.S., I don't see anything of note, just a couple yellow flag reports. In terms of tomorrow, looking forward, don't really see much there either. We have JOLTS job openings. So very, very quiet on the macroeconomic front for the first 2 days of this week. In terms of current market conditions, obviously a lot of volatility came off on Friday with that big move up. We indeed had a 2 standard deviation move on 3 of the 4 indices. Only the Russell, which had put in a 2 standard deviation move the day before, was in at 1 standard deviation move. If you look at the last 4 days, it's quite a cluster of volatility. We'll look at the chart here in just a second. But IV percentile still very, very low. 16 on the S&P, 12 on the Russell, 9 on the NASDAQ, and 18 on the Dow. Short-term VIX at 13.65. So in terms of those charts, let's take a look at that. So the SPX, you talk about volatility, and really kind of volatility and then end up nowhere. That has been really the definition of this recent activity. We had the pullback, we had the recovery, then the 7 days through the Thanksgiving week of really small range. But ever since then, you know, the 5 days of last week were all large body candles, but going just frankly back and forth. And if you think about where did the week start? Right here. That's the open. Where did the week end? Right here. That's the close. Same place. For all that action last week, we're just right back where we were, and you can see this very nicely on the weekly candle. Look at that. Perfect doji. Big tails, though great big tail on the bottom. I would say that the bulls won and that they fought off a really big attempt on Thursday for a breakdown. So that's the SPX. You heard in the morning reading the talk about the symmetrical triangle, and what they're looking at here is this pattern across here. Draw a line across here and then across here. And since we were in a long-term to intermediate term bullish pattern coming into this, the expectation is that the ascending triangle would break to the top side, which would lead us to the former all-time highs back in May. Now, whether we can get past that, a measuring pattern on this ascending triangle would seem to project a target out well past the former all-time highs. So if all that works out, we could have a very nice finish to the year. So obviously these symmetrical patterns, ascending triangles and so forth, don't always work, and they don't always make their measured targets, but that certainly is lining up with a number of interesting things. In terms of the Russell, nowhere near as pretty action as you had with the S&P. It did recover in a big way on Friday, but nowhere near in a relative terms what the SPX did. For example, it pretty much covered up about 80% of the fall from Thursday morning. So if it had done the same kind of action, we would be up here near this dot right here as opposed to a close down here. So bullish in the recovery, but nowhere near as bullish as the SPX. NASDAQ very strong. You had the 52-week high that was put in on Wednesday and then failed, but then totally recovered with the action on Friday. Quite bullish there on the NASDAQ. And then finally the Dow, also very, very bullish. So really 3 of the 4 indices, you could make a strong case for the bullish recovery, and that you know, all looks pretty strong as of the end of the week. In terms of volatility, obviously you would expect a volatility crush, and indeed, you know, you're down here in the 16 area, so back into that bull market volatility range, and action so far today really having accomplished nothing of note. Bonds also saw some wicked action last week, especially you see the big gap. This is TLT, so the ETF, you show the gap here. And but a big reversal on that pattern on Friday, though obviously got a ways to go to come back to where it was before the Euro announcement on Thursday. So that's probably enough on the charts for the moment. Let's go back to our daily report. Have some changes here. Phase 5 still break of horizontal diagonal support. We'll look and see where this goes today. We perhaps will change that, go back to phase 2 perhaps if we get a trend reversal, and so far it looks like we're going to do that. IBD status remains uptrend under pressure. Accumulation distribution score did improve for the S&P and the NASDAQ, both going back to a C. GMI index also had a change. It's now 4 out of 6. With the buy signal still being retained, though that author remains largely in cash. Primary market condition still remains neutral bear. Stock chart still remains quite chopped and quite mixed on the short-term and long-term time frames. So when you put all this together, it's a market in transition, waiting for a breakout one side or the other. All in all, we're still expecting that this will break to the north side, to the bullish side, and yet you got to look, there's a lot of red here, and that bias to the bullish side might be, frankly, even with Friday's action, a little bit more in question than it would have been at the beginning of last week. So we're still going with that transition with a bullish bias, but you got to be pretty defensive right now, so be careful with that. Intermediate term market posture is bearish with an upslope sentiment, more warning there. And in terms of position sizing opinions, you've got more warnings here. Long side portfolio exposure at 50%. The volatility based metric coming in also at 50%, so more warnings. In terms of that intermediate market posture, bearish. S&P and the Russell now both bearish, though the Dow and the NASDAQ retain their very bullish intermediate term market posture. In terms of that hedge warning status, we're still at level 1, which is yellow light. That's like tapping those brake lights on the car as you're coming into the intersection, and that car in front of you is looking like they're going to want to stop. So caution approach, and we certainly see plenty of reasons for that thus far. Also, I've added a couple little metrics in here. The equity risk on a short term using a 1 to 10 scale would currently be a 6, and on an intermediate term would also be a 6, so a little bit above the average, a little bit of risk in both of those metrics. In terms of our special measures, you see volatility. Some of the things ebbed off with that action on Friday. Distribution day count still very, very high. S&P 7, NASDAQ 8. You see the current week's expected move came down quite a bit, and there's always a lot of warning in the recent trading days, but the fact that the market makers aren't pricing that in, I think, should be noted for the bulls. So this was up over 40 a few days ago. That's now dropped to a 28.9 now that we've gotten past the monthly employment report. In terms of new highs, new lows, you see almost 400 new lows in the New York Stock Exchange on Friday, so that's a warning status. And then on the intermarket risk aversion indicators, we actually had a slight improvement. 1 is now risk on, but they're still in the face of 4 as risk off. We've added some sentiment indicators. This one here from CNN Money, fear and greed index. You see the sentiment is slightly to the greed side. In terms of special opinions, VIX is back inside the acceptable window the first day back, so it's technically okay to initiate new positions for novice traders. At the same time, you got to recognize it's first day back. Maybe you don't go in with a full position size, and you look for some really nice setups. In terms of covered call strategies and put selling, we're still in the intermediate term bearish posture, so conditions are not acceptable to initiate new positions if you are a novice trader. More aggressive traders will want to take advantage of that increased premium that's available with a VIX around a 16 to 17, and yet at the same time use the various metrics to be able to bring in additional defensiveness. That 1-to-1 ratio of out of the money, in the money, a 1-to-1 ratio of high beta to low beta. Maybe go more low beta if you don't like that mix. And then, of course, the other aspect is always position size and scale that you're willing to own, whether you're doing cover calls or put selling. Kind of keep that position size in check to something that you're truly comfortable holding for a while, because you might just end up holding it for a while given the current market conditions. We've had a lot of warnings up above. In terms of sector specific, you see that we did get a lot of healing on Friday, but yet short-term, intermediate term, it was not universal. Transportation, energy, utilities are still in poor shape. And but on the flip side, consumer discretionary, consumer staples, even healthcare and technology held up a little bit better. In terms of specifics, telecommunication, small sector, but up 2.68%. Financials up, and this is a large sector. This was a key driver for the action on Friday, up 2.66%. Healthcare up nicely. Technology as well. Really only energy, and you look at this, it continues to be a very, very battered sector. When everybody else is up well over 1% and some approaching 3%, energy was down 0.5%. In terms of the relative rotation graph, again, another sign that this is not a healthy bull market. There are not a lot of green tails moving towards that upper right corner in this. In fact, most of these are kind of tailing off and moving into a weakening posture. So XSD, the semiconductor index, we also mentioned that in the morning reading, is probably the healthiest of the industry groups that are mentioned in this relative rotation graph. So that should be enough for today. As always, if you find that your trading is being helped by the information that you're getting here in the morning, we greatly appreciate that you like us on YouTube, subscribe to us on the YouTube channel. If you have Twitter followers, that you retweet us to your Twitter followers, to your StockTwit followers, etc. Very much appreciated, as that acknowledges, and we take note of that, that acknowledges that you're getting something of value here, and that encourages us to continue to provide this free market preview each morning. The other thing is, of course, we have a number of special opportunities available, and let's see, I think I'll mention this one here today. Obviously, we put these various concepts into practice, and you can follow that in much greater depth. There's a lot of other resources that are available to the members. We do use a number of different strategies, trading a portfolio, using equities, ETFs, options. We have option income strategies, including our special SPX mortgage strategy. That's how we pay our mortgage, is with that strategy. And then, of course, other resources that you can see more details. If you go to this website, you'll see more details, but all of that is very, very modest for $50 a month, so you might want to check that out. Other activities going on. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers, and of course, full disclosures are available at this website. And we'll see you back here tomorrow morning for the market preview from Falcon Global. Good trading to all of you.